Well, welcome everybody. My name is Sandra Vidrio, and it's a pleasure to connect with each one of you. Thank you so much for joining us, whether it's through Zoom or if it's through Facebook Live. As mentioned, our webinar series for today, we're bringing back our Pros Who Know webinar series, and the topic for today is regarding credit. Personal credit, we'll talk a little bit about business credit, and we'll talk about new business funding opportunities for those existing businesses. So with that being said, I want to say thank you once again. And today's workshop is in collaboration with Your Credit Pulse as well as World Financial Group. I want to send a quick reminder on how to use the chat box feature. So if you're logging in through Zoom, if you're using a computer, you just simply select the chat box that appears on your screen. And if you're using either a tablet or your smartphone or any other mobile device, you just simply select the more option and then you will find the chat feature. That way you can ask your questions during the Q&A session or throughout the presentation. And we will also be having, we also have the feature to listen in Spanish. Así que tenemos la función para que puedan escuchar el seminario web de hoy en español. Así que simplemente seleccione donde dice More y va a mirar donde dice Language Interpretation para que usted pueda acceder en español. O si prefiere inglés, well, you can tune in English. So we will now continue. I would like to, before getting started, say thank you to the following companies that allow us to bring these webinars on a weekly basis. We have been doing these webinar series weekly since the start of the pandemic. And so we want to say thank you to Bank of America, Comcast, Bank of the West, Chevron, FHL Bank San Francisco, Donna G. Sales, Wells Fargo, Tri-County Banks, JP Morgan Chase and Company, and Union Bank. Thank you so much for your support towards our organization, and we're looking forward to the great programming that we have lined up for 2021. This is our agenda for today. So as mentioned, my name is Sandra Vidrio. Our presenter for today will have Frank Orejel, who will be introducing Thomari Story-Harden, who is our presenter for today's workshop. And of course, we will be concluding with a Q&A session at the end. Really quickly, I just want to share briefly about the foundation, the Fresno Area Hispanic Foundation. If this is your first time attending our webinar, I would like to say welcome. And if you're a recurring participant, thank you for your support. Our organization, as you can see here, it's a team of 6. So we have Allison, Yeti, Dora, Ruby, David, and myself. And we're here to help out our small business community, whether you're an entrepreneur in your startup phase or you're an existing business looking for relief funds, looking for support, what we call technical assistance. Give us a call. We're here to help you, and we will help you navigate the situation in which you're in. And we also like to share about our weekly webinars. So after today's presentation, you will all be receiving a survey. That way you can let us know of future topics that you want to see in the upcoming weeks and the upcoming months. And we also have a microloan program. And so there's a lot of new programming that will be introduced in the upcoming days. So please stay tuned. And the best way to connect with us is, here is our contact number. Give us a call. You can also reach us by visiting our website or visiting our content that we have through our social media platforms. So just simply follow us at Fresno AHF. And I also want to remind you that today's presentation is currently being recorded and transmitted live. That way you can review it at a later time. So with that being said, I would now like to welcome Frank Orejel. Frank, are you connected here with us?
Yes, can you hear me?
Yes, perfect.
Awesome. Well, first and foremost, I just want to say thank you to Sandra and the foundation for putting this Zoom webinar together. Thank you for the introduction as well. One of the things that we do is we try to ensure that we provide some kind of resource for the community, and through the foundation we're able to do that. So thank you to the foundation. Thank you, Sandra, for all your hard work. Without further ado, through Larry Tellis and myself, we want to introduce Mr. Thomari Story-Harden. This gentleman, I've known him for quite some time, going on a little more than 12 years now. And I met him in business. And just to give you a little background on him, This gentleman is an ex-professional baseball player. Played with the Dodgers, woohoo, for about 8 years, right? And so, one of the things, and not one of the things, but a lot of the things that of value that he brings is how to get your credit fixed. You know, whether you need it for yourself personally, or for your business, or even then how to apply for a business loan. Um, so he's been in business quite some time. He's someone that I trust and that I've used personally, and I believe he's going to bring a huge education resource to the community. I'm sure he'll have his number up with his information if you guys want to obviously get more information from him. Um, and again, thank you to the foundation and Miss Sandra Video for putting everything together. Without further ado, I want to introduce Mr. Thomari Story-Harden. Thomari, you on the call?
Yes, I'm on the call. How's it going? Well, Frank, I just
Awesome.
can you
Take it away, brother.
Can you guys hear me? All right.
Yes.
Okay. Hey, Frank, thank you so much for that presentation or that introduction as well. We go way back, 12 years of friendship, man. I just want to say thank you for the opportunity to be a part of the organization and to bring information that I can spread the things that I've learned over the years, and I can help others with it. So I just want to thank you for the opportunity. One of the things that I wanted to talk about today, other than credit and the different loans and things that we can do, is just what we're doing right now. So we're forming and we're coming together, and we're sharing information that's going to help the community. And I always, to the day I die, I want to be a part of that. So I just want to thank Sandra for the opportunity as well. I want to thank Larry as well. Just working with the team, it's meant so much to me, and I just want to tell you how much I appreciate what you guys have, the platform that you guys are creating, and the knowledge that you guys are spreading. I really appreciate it, and thank you for the opportunity.
Absolutely. Thank you so much. And as mentioned, we'll get started. I want to remind our participants, whether you're on Zoom or on Facebook Live, submit your questions during the presentation. We will be having a Q&A session, and we'll be speaking with Thomari, who's an expert in regards to personal credit, rebuilding credit, establishing credit perhaps. And we also have his team member, Manny, who's joining us on the call. So thank you. And Thomari, I have made you host. That way you can share your screen. If we run into any trouble, just let me know and I'll be happy to pull up the backup presentation.
Okay, cool, perfect. Okay, perfect. Can you actually pull up the actual the video?
Do you want to get started with the video? Yeah, I could definitely do that.
Okay, perfect.
So then I'll get started with the video, and perfect. So then let's do. Everyone seeing the screen? Do you see on the screen the FICO Understanding Your Credit?
Yes.
Perfect. Okay, then I'll go ahead and hit play.
Consider this. If you were lending your own money to a friend, you'd want to make sure you'll get paid back. You'd probably wonder, have they paid their past debts on time? How much debt do they already have? And who else are they approaching for the loan? FICO scores help lenders answer these same questions every day, but through a mathematical formula that makes the lending decisions faster, safer, and more fair. So it's really important you understand how your credit activities and behaviors are considered when calculating FICO scores. FICO scores focus on 5 key predictive categories: your payment history, how much you owe, how long you've had credit, if you've recently sought new credit, and the types of credit you've used. Clearly, your payment history and level of debt substantially drive your FICO scores. Have you missed payments? If so, how often, how recently, and how late were they? Have you had debts turned over to a collection agency? Do you have foreclosures, or have you filed for bankruptcy? The more recent, frequent, and severe the reported negative items are, the bigger the impact on your scores. Next, there's the debt you're already carrying. Are your credit cards nearly maxed out? How many accounts with balances do you have? how much of your available credit is being used. If you're overextended, you're more likely to miss future payments. Then there's how long you've had established credit, from your oldest to your newest account, and an average age of all your accounts. FICO scores also consider how often you've actively applied for credit in the past year. Rate shopping is accommodated for, and promotional, insurance, and employment inquiries don't count against you. Whenever you apply for credit, there's a good chance your lender is using FICO scores to help make that approval decision. So it's important that you understand your FICO scores, because it could help you know whether you qualify for low rates on your next loan. Know your FICO scores. Understand what goes into your scores.
Okay. So that gives you kind of like just a brief summary on how credit works. I really like that video because it keeps everything very simple. Simple the better when it comes to credit. You don't want to overthink it. One of the things that I feel as though the first thing that everybody should have is a way to check their credit. So a credit monitoring service, or even Credit Karma. I know a lot of people say Credit Karma is the devil, but actually having something is better than nothing. And at least with Credit Karma, it gives you Equifax and TransUnion, which is 2 out of the 3 bureaus. And having both of those versus having nothing will at least give you just at least a snapshot as far as where you're at. Now, the first thing that I always recommend, and I try to break down when it comes to credit, is the difference between, well, the 2 different types of credit. One is installment credit. This represents 10% of your score. Okay, so a student loan, a car loan, personal loan, those are installment debts. So when you pay the actual minimum balance, minimum due, let's just say it's a car payment of $250. All right, you pay your car note, and every month on the 15th, let's just say the car note's due, you make your payment, and that will show FICO that your payment history, if you can make sure it's all green and you're paying it on time, then that's actually a really good thing when FICO is going to actually see that, hey, you paid your debt, and it's going to give you almost like bonus points for it. That's a good way of thinking of it. Like if you go to Save Mart or something like that, and you get cash back points. So think about every time you make your payment on time, you can look on the other side and say, okay, well, it helped my score because I don't have any late payments and things of that nature. So that's installment debt. It actually represents 10% of your score. Now, revolving credit, and that's kind of like the kicker right there. Revolving credit is 30% of your score. So not only do you want to make the payments on the, so think about a revolving line, and it has an ending date and a start date. The ending date is the most important date, because whatever your payment is by the ending date. And the funny thing is, with credit cards, every credit card has a different ending date. So if you don't know it, you could either look online, you can call your credit card company, or what you can do is you can actually it's on your statement. So you can actually just look at your statement, and it's going to show you the ending date. Okay, so based off of that ending date, you want to make sure the credit card balance to limit ratio is between 1% and 25%. Okay, so if you have $1,000 credit card and you've used 250 of it, so and it doesn't matter if you want to use it for gas, if you want to use it for any type of bill that you have, but just know, if I use it, what will my balance to limit ratio be? Okay, and if you can always keep that and have a good idea where you're at with that, and you can keep it around 25%. Now with that revolving credit line, now you're able to be able to keep that at 25%. Now that's how your score is going to continue to go up. Okay, so very important: installment debt, revolving debt. Having 2 different types of debt, that's another 10% right there. So just from having one installment, and like I said, we gave some examples: student loan, personal loan, car payment, and then you have like, and let's just say you don't have, it's really hard for you to get revolving credit. Well, there's what's called secured credit cards. So basically, this is how you can get if you get a secured card, you're basically putting your own money down and you're borrowing against it. So, so getting that secured card or getting that credit card, now you have the other type of credit with it, which is revolving, 30% of the score, right? Having two different types, 10%. So 50% of your credit is just making sure if you can have the installment, revolving, make the payments on time, that's half of it right there. And I don't know if I made that sound difficult or not, but it's really, that's how simple it is. Number one, that video articulates everything. You know, pay your bills. You know, because if you can pay your bills, it just puts you in a great position to build credit. Now, things happen. We're in a pandemic right now, and sometimes it's hard. You know, let's be honest. There's all kinds of different um, ways of or there's different relief funds and there's different aids out there for us right now. But at the end of the day, you know, things could get tough, and say you miss a payment. Don't feel like it's the end of the world. There's what's called the rebound period. And the rebound period is simply 6 months of good payment history after any late. And you don't, that rebound period won't affect your score, or the late won't affect your score if you can get through the rebound period. 6 months of good history. And so don't feel discouraged if you have late payments and you've had them in the past, because it's all a matter of having a plan moving forward and working on building your credit up from there. And when it comes to, you know, credit builder links and things like that, we can help you with that if you need help. And there's a lot of options on just researching it online as well. But we can definitely help you with that. So now that's the foundation of just making your payment hit, you know, making your payments on time. And one of the things that I want to talk about too is inquiries. Okay, I get calls every day. Thomari, I've got, I've got 15 inquiries, you know, because I went to try to apply for a car, and they, what you call, shotgun my credit. So they just ran my credit with every lender they had possible. So all of a sudden I went from one inquiry because I was really good, but they didn't tell me that they're going to run every possible, lender that they have available. And so now they're wanting inquiry removal, because inquiries stay on your credit for 2 years. A lot of people don't tell you that. And in those 2 years, you're literally, it's taking, well, actually every inquiry is 2 to 4 point ding to your credit score. So the difference between inquiries, there's what's called hard inquiries. That's when you go to the dealership, or if you get a mortgage, they have to pull a hard inquiry. If you like cars, houses, things like that, or if you go to the bank and you apply for a personal loan, again, they're going to pull your credit. That's a hard inquiry. Now, when you go to T-Mobile, they can tell you, hey, we'll pull your credit, but we're going to pull a soft inquiry, which a soft inquiry does not affect your score at all. So knowing the different types of inquiries can really save a ton of points. So you're not continuing to get your credit ran hard inquiry, and then every time 2 to 4 points, it's going to ding your score. Okay, and then you're probably going to be coming to me and saying, hey, I need inquiry removal now. So just knowing the different types of inquiries can really save you points in the long run as well. And another thing is knowing when you apply somewhere, you can simply ask them who they pull from. So remember earlier in the conversation, I talked about having like some type of monitoring service so you can see your credit. Well, there's a section in most monitoring services where it's going to show you your inquiries, and those are going to show you your hard inquiries. So if you go to Bank of America and you're trying to apply for a personal loan, you can ask them, so who do you guys pull from for your personal loans? Because they can pull from one credit bureau for personal loans. They can pull from a whole different lender for, like, let's just say a car loan or a credit card. So just asking the question of who do you guys pull from will help you so much, because then you can go to your computer and you can say, okay, where am I? Because they told me they pull from TransUnion for the credit cards, like Navy Fed. Navy Fed pulls, if you're trying to apply for a credit card, I know for a fact Navy Fed is going to pull from TransUnion, right? So you can go to your Credit Karma, or you can go to your Identity IQ, your monitoring service, and you can say, okay, how does my TransUnion profile look? Because because the monitoring service, that's all soft pulls. So it doesn't affect your credit at all. You can literally pull it up in 5 minutes or 5 seconds, as long as it takes to pull it up on your phone or on the computer. And then you can just look and kind of evaluate your report and ask yourself, do you have any lates? What's the payment history? What's the utilization on the revolving credit that we just went over? Is it 1 to 25%? You can kind of start being the underwriter, because wouldn't it be nice to kind of know what they look for, and then you can look yourself before they pull it, and then you can kind of underwrite your own file. So if you have money and someone was going to borrow money from you, you can look at him, you can kind of role play a little bit, and you can ask, Johnny, okay, what's your payment history like? And so you can kind of reverse engineer it and look at your own, and you can act like you're the underwriter. You can play fun games like this, because at the end of the day, this is your credit, and the more that you're able to know your credit and you know how your credit works, the more you're able to leverage your credit, and then you can provide different resources for your family, and in times of need like this, or even when we get past this, and build a solid foundation. We predominantly work with mortgage lenders, so that's 98% of where our clients come from, and we simply help people break down their credit, so when they're applying for their home loan, they know some of the different secrets that the mortgage people are going to want to know. Like, for instance, we talked about the 3 bureaus. Most mortgage lenders, what they're going to look at is they're going to look at all 3 bureaus, but they're going to throw away your high score. So if you have let's just say you have a 700, a 650, and a 620. So the 620 and the 700, they go out the window, and it's whatever the middle score is. So the 650 is what they're going to judge you on in terms of whether you qualify for your credit wise, right? So knowing that, even, okay, so because some people think it's an average, right? They simply, so you can even have a credit score lower than that, higher than that, but at the end of the day, what is your middle score? And that's where, again, that monitoring service comes into play. Because if you can have a monitoring service that shows you all 3 bureaus, and Experian has it, TransUnion, Equifax, they have their own. But having that will allow you to be your own underwriter, and in some regards, to ask yourself, well, where am I at with, if they threw out our high score and our low score, how do we qualify? Where would we be, at least ballpark wise? So that's very important, because when you transition in on the mortgage side of things, you want to make sure that the lender will know. I mean, you want to be the underwriter, so you can, when you take the information to the lender, they'll be able to answer those questions, and you'll be able to answer those questions before you actually go. Now, as you can see right here, what does credit mean? So everyone knows, I feel as though everyone has their kind of version of what good credit is, because I've talked to clients and I'll ask them, so what do you consider good credit? And they'll say, well, for me, anything over 700, I'm going to be doing backflips, because right now I'm at a 600, right? So this kind of tells you the official standards of what does credit mean. So a 750 to an 850, you're going to get the same rate. It's just like 750 or above. It's excellent credit. Very, very hard to 750 to 850. Once you get over 800, there's other factors like history and things like that. But definitely, if you're between 750 and 850, just know that you're in really good. It's an excellent score. Exceptional score. 700 to 750, that would be considered good. Now, when it comes to mortgages, once you get to 700 and above, that typically allows you to be in the what they call conventional space. So conventional, if you need to go conventional, 700 or above, you're good to go. Some lenders 680 and above, you're good to go conventionally. Now, as far as good credit, 650 to 700. Now, when it comes to mortgages, now this one when you consider good credit, most lenders you should be fine with a 650 to 7, and it really just all depends on the program. So every lender is going to be a little different, but once you get in that 650 to 700, you're right. I mean, there may be a couple tweaks, but you're either there or you're almost there. Now, 600 to 650. Now, this is where there may be some homework that you have to do. That's what you consider bad credit. Some people, again, they don't consider it bad credit, but from a lender's perspective, 650, it's or 600, it puts you in a tier that sometimes you have to, just kind of go back to the foundation of what we talked about earlier. Okay. And 600 and below, believe it or not, I get a lot of those clients. Again, we talked about earlier, yes, it's very bad. It's bad credit, but don't sweep it on the rug, attack it head on. And it's all about going back to the foundation, like we talked about earlier. So even though it's very bad, you can always improve it in relatively short period of time if you know and you practice some of the principles we just went over. Okay. Now, I kind of touched on this. So every lender is going to be a little different. So when you're sitting down with the lenders, don't be afraid to ask them what programs do they offer, and then more information you can get on the FHAs or conventional. Like I said, more than likely it's going to be one of those. And there's also different down payment assistance programs and things like that you have to get to a certain amount. And so even if you like, as far as you're high risk right here in the 580s, everyone should have a goal. And based off of what I just went over, these are like as far as how it pertains to lenders. But I feel as though everybody should have their own personal goal of what they consider, or what they want to go, or what score they want to reach. And this kind of just it's a color coordination of bad credit, lending rates wise, all the way up to good credit. But definitely ask the lender what programs that they have access to. I think that's very, very important. Okay, so we went over this when we touched on it earlier. So when it comes to this pie, I love this pie because it really breaks it down in percentages. So remember we talked about the 30% and the utilization. That's where that 30% comes, that pie right there. So when it comes to 30% utilization, that's in your head, you always want to think about the accumulative utilization. So if you have 4 credit cards, think about limit wise. Let's just say they're all $1,000, right? So that means you have $4,000 of available credit. Okay. And so the goal is knowing the available credit when it comes to revolving. And that's what we're talking about, because we want to show the lenders that we're borrowing money and we're paying it back. So you don't want to keep your credit cards at 0 and just let them sit. And a lot of people really, they don't really understand that, just because they feel as though if they pay their revolving credit off, all of it to 0, then that's a good thing. But to lenders and to FICO, when they're calculating your score, you want to show that you're borrowing and paying it back. So you do that by, again, ask yourself, what is the balance to limit utilization percentage? And we talked about it earlier, 1% to 25%. Okay. And as long as you keep a little bitty balance, then that's going to you're going to start seeing your score take off. And knowing what the ending date is. So if you know what the ending date is, you can control how the credit card balances update with the bureaus. Because oftentimes I'll be sitting with a client and they'll look at the credit report and they're saying, you know what, I paid that down already. I paid it down 2 days ago. But if they didn't understand what the ending date was on that statement, it takes a lot longer to update than 2 days. Typically, it takes 10 days to update from the ending date. So let's just hypothetically say the balance ending date on your Discover card is on the 15th. And right now it's $1,000 card, but you've used 950 of it just because you needed it. And so before the 15th, because today's the 14th, you're going to pay it down to $250, right? So 10 days after that, since you met the cutoff on the 15th because you paid it on the 14th, it's gonna take 10 days to update. So on the 25th, that's how the bureaus are gonna update that payment. So that's a nugget right there, because you can start taking control over how they report to the bureaus on your behalf, because you know your ending dates and you know when your due dates are, and you know the difference between the two, right? I told you earlier the different types of credit as well, having an installment credit and having revolving credit. That's 10% right there, right? So we went over that as well. And payment history, just making your payments on time is a huge piece, 35% of your credit. Okay. And then how long you've had that credit. This is one of the things that another nugget I'll give you. Revolving credit, try not to ever close it. Installment credit, try to close it. Try to pay it off at some point. You got your auto loan, you got your student loan. At some point, you want to pay that off, and it's going to be like a golden nugget on your credit report. But on a revolving credit, you never want to close it. And so it's always going to be, if you can keep it open for as many years as possible. Imagine having a credit card you've had for 15 years. Well, that's the credit history piece right there, and that's 15% of your credit. So this kind of just reiterates the paying the bills on time that we talked about. And at the end of the day, if you're able to pay your bills on time, that's the foundation of the credit, hence that video that we watched. Now, when it comes to credit limits and credit cards, really the history, I would take history over limits any day, unless you're looking for funding. Now, if you're looking for funding, you can when it comes to credit cards, let's just say you start off with a $500 credit card. Every 6 months, you can actually ask for an extension if your credit's in order. So that kind of, you want to know where you're at with that. But you want to ask for extensions, because if you ever need funding or you need that security blanket, and sometimes you might need that credit card that helps you through a pandemic. Well, having a higher limit will always allow the lender to give you close to or around what you already have, because you've already shown that credibility, you've already shown that trust. Okay, so credit limits, I'm conscious of my credit limits. I'm always trying to have the most amount of limits as possible, because I know for me personally, funding or getting extensions and things like that is something that I'm interested in, because I'm competitive. So if my wife has 20,000, I'm getting 30,000. Right? Just one of the things with me. But you could always go to your lenders or the credit card lender and ask for an extension. This also helps as a strategy as well, because let's just say your utilization is a little out of whack. If you ask for an extension and you're granted an extension and you get more limit, that automatically pushes your utilization down. Okay, so again, that's a strategy right there, where it can ultimately help you having a higher limit, and it will. And anytime you can push your utilization down, that's when your points go up on your credit, like those reward points that we talked about earlier. Okay, we went over credit history as well. Let me see the next one. Okay, so when it comes to the FICO score, it's always important to make sure that the information is accurate with FICO. So if you have a junior, like let's just say, because I'm a senior, my son's a junior. Okay, now he's 12 right now, but when he's 18, and when he's applying for, because he's going to have good credit by the time he's 18, just from his dad's a credit guy. But at the end of the day, since his name is similar to my name, we always have to make sure our credit reports don't come together and merge. Okay, so knowing exactly how your name reads with every bureau will directly, and it could answer questions of why is this collection on my credit report? It could be a similar name, because somebody in your family or just somebody out there has a similar name and may have lived at an address that's close to where you're at. So you always want to know what the credit bureaus have in terms of, um, you know, the FICO information. And these are things that you that the credit bureaus don't have, because they can't uh, use this against you in terms of granting you credit, or your score does not ever reflect on your marital status, your religion, national origin, sex, color, race, age, occupation, employment history, um, title, employment or salary. Uh, as far as your particular address on the file, it will show that, but not as far as current interest rates, loans, things like that. So just knowing that information will definitely help as well. Okay, next slide. Okay, this is big. Fraud alerts. Okay, now if you've ever been a victim of identity theft, or if you ever want to protect yourself from being a victim of identity theft, putting a fraud alert on your credit report will definitely help you as far as a layer of security. And what I mean by that is you can call the credit bureaus and you can say, I want a 90-day fraud alert. I want a 7-year fraud alert. So anytime my credit is ever ran, I want a phone call, and you give them your number to make sure it's you. Now, this knowledge will definitely help you protect yourself from, somebody taking and compromising your credit and trying to run up and buy a car or I've heard so many horror stories over the years. So making sure that your credit's protected. It's as simply as calling all 3 bureaus, and there's different services out there that can do it for you as well, and they will help you with the credit bureaus. Will put what's called a fraud alert, and really, I know it sounds fraud alert, well, it's just basically it is what it sounds like. Make sure that somebody's not taking my identity. I don't care if you deny. If you're able to call me, give me a call so you can make sure that who is trying to apply if that's the case. So fraud alert is how you can protect your credit. And so that this I'm really big in Q&A, and so this is my contact information, also Janice's contact information. So if you guys ever have any questions or anything like that, Manny's on the call as well. I saw you dropped a note in there. If there's any questions, I would like, if I have time, I don't know if I went over my time or not, but if I have time, I'm willing to take live questions whenever, if it permits, whenever that permits. But I just wanted to make sure I got all that in, because I know that's a lot of information. And again, thank you for giving me this platform.
Absolutely. Thank you so much, Thomari. We've all learned a little bit of something, that we can immediately apply, whether it's our personal credit or business credit. And I want to encourage our participants. You have now the option to unmute yourself. And so I do see some questions here in the chat box that we can go ahead and get started. So one of the very first questions was, when you have your company registered with an EIN number, the company creates credit, or I'm assuming the question is, at what point does the company start creating credit? Do you have to have that EIN in order to create credit, business credit?
Well, so you don't necessarily have to have an EIN to create business credit. It definitely, the EIN is really important for the IRS, Uncle Sam. So it's like your social security number for your business. And with that EIN number, you can actually use that EIN number to start different processes for your credit. So a DUNS number is another. So your DUNS number is important as well. That's typically what you use to build your business credit, is your DUNS number. You can actually reach out to Dun and Bradstreet and and ask them. They're going to try to upsell you, but you can ask them, what's my DUNS number? Because most times when you're applying for any type of a loan, or you're using your business and you're applying for something, you want to make sure you have your EIN number, your tax identification number, and your DUNS number. With both of those, that's like your digital fingerprint, for your company, and your company identity. Because at the end of the day, the goal is to have your social over here, and you have your DUNS number over here, you have your EIN over here, and the more you can operate separately. So if you get a loan, ideally you want it on over here in the DUNS and the EIN space, and then you can keep your personal assets separate. And so it's a layer of protection that you can create just by having an EIN number and having a DUNS number as well.
Perfect. Thank you. And then another question here is, does transferring a balance to another card affect your credit? Does it make your credit look bad?
So typically when you do balance transfers, at least when I do them, it's a strategy, so so it can affect your credit, but really it comes down to interest rates, because you have to know, if I'm balance transferring this card to that card, will this help me in terms of interest rates? So you just have to compare the two. This is different homework you can do. Also, depending on where you're pulling from, it could help your utilization. So if one card's maxed out, let's just say it's like, because anytime you go over 100%, it's a huge shock to the credit. I don't know if a lot of people know that, but let's just say you have $1,000 card, but somehow, some way, you owe $1,020, right? So that's pulling your credit down so much. But if you balance transfer another card that, your utilization's a lot better, and you at least pull that $20, or like, let's just say you put $100 on it, that's going to help you a lot. Even though that card's still maxed out, so to speak, it's not over 100%. So balance transfers can help your credit depending on how you're pulling and what interest rates attached to each account. And sometimes you just have to do some math and see, hey, this is going to help my credit, or you have to just understand why you're doing it, and that will a lot of times dictate whether it's the right move or if it's going to help your credit or not. If you just kind of understand where you're pulling and where you're taking it to.
Perfect. And the following question is regarding credit cards being charged off. So the question itself reads, if you have a credit card that was charged off, does it still affect your credit? And once it's charged off, can third-party companies collect the charge-off debt?
Sandra, that's a really good question. Charge-off debt, what that really means is it's with the original creditor. So let's just talk about charge-offs, and you have collections. Collections are with a third party. That means they purchase the debt most of the time for pennies on the dollar, and now they purchase charge-offs. So it could be a portfolio of debt of a bunch of charge-offs, right? So charge-offs simply means that they've sold. Well, actually, it just all depends on the status of the charge-off. If the charge-off still has a balance on there, that means it's with the original creditor still. Okay. So if it has, like, say it's a Discover card that has a $15,000 balance, it was a $20,000, or I mean, I'm sorry, is it mine? So a charge-off, the status, let's just say that it has a balance to it. So with that balance, that means it's still with Discover. Okay. So paying that off just simply means, and what Discover mostly is going to do is they're going to take that, let's just say it was 15,000, they're going to bring it down to 0, and now that's a paid charge off by the client. There's another way where the collection company, ABC Collections over here, they bought that charge off, and so now it's going to show 0 in the credit report, but now it's going to go, and now that ABC Collection is going to reporting it, it's going to show 0 balance on the credit report, but then it's also going to show negative on the credit report. So now not only is it going to show negative with just Discover reporting it, now that collection company is going to report it as well. So it's like double whammy. And so the whole idea of, you kind of have to navigate and figure out the best way for you to approach it. But oftentimes in the credit repair space, we see a lot of charge-offs. That's why they're coming to us, and we can help dispute different inaccuracies of that debt. And if we can show even $1 off of what they're reporting, or let's just say there's a that Discover card, it's reporting 15,000 with TransUnion, $15,001 with Equifax, and 15,000 with Experian. Well, they can't all be right. So that's how we're able to get negative items deleted off a credit report, by going through the dispute process. I don't know. At this point, did I answer that question correctly? I mean, like, did I answer the full circle of the question?
We'll have the person that asked the question let us know in the chat box. There's two more questions that I saw here. One of them is, if I paid off a business microloan, should it have raised my credit?
So typically when you pay off loan and debts, if it's an installment, remember we talked about installment accounts earlier, it not necessarily is going to raise your credit, just because that account, that, let's just say, remember the 10% installment, which typically microloans are. So by paying that off to zero, it's more of a nugget, so to speak, for the lender to show, hey, I borrowed money and I paid it all back. Remember, you're supposed to pay back installment debt. So that's good, but it doesn't. What's really going to dictate what raises, or if your score actually raises from that, is what the status of, where the status is on the revolving debt, and if there's any other installment debt that's driving your score. So just simply paying off the microloan doesn't necessarily mean your score is going to go up, but just remember it is a positive thing, because you paid off an installment debt that's like gold on a credit report when you're trying to get a car or you're trying to get a personal loan, because you're showing the lender, they trusted me with this money. I made sure I paid it back. Now they're more likely going to trust you with more loans and more money, just because you're able to do that. And obviously the rest of the credit report will factor in as well.
Absolutely. And then the final question here that we see on the chat box is, can one request for a lower interest rate versus a higher credit line?
Well, ultimately, like, you can request what you want, but most of the time, like, the lenders are gonna let you know what you qualify for. So they're gonna take your credit history in account. They're gonna take your finances in account. So if they're asking for other documents, like, some lenders, or they want tax returns. Some lenders want to see, your last couple pay stubs, and so they just want to know that if you're gonna, pay them back. So most of the time, you don't have an option. There are some lenders, especially now in business funding, where they have different options that you can choose from. Like Divi's one of them, where they'll give you like a weekly option, a weekly option, bi-weekly option, and a monthly option. And there's different interest rates attached to that. But most will let you know what you qualify for.
Okay, thank you. And then we just got another question here. And the question is, we don't know if if it has been answered yet or not, but the question is, if someone has debt that has now gone into collection and they want to go back and start paying it off, is there a way for that client to negotiate a price? That way they can start building that credit score again. So I guess what.
Good. Your audience got some good questions today. That's another good one. So the answer to the question is yes. You can turn into the negotiator in these situations. Just know that whenever you're approaching a collection company, number one, if you agree to terms over the phone, you're what's called validating the debt, or you can validate the debt. Okay. I know, like, when it comes to collection agencies, some of them are ethical, some of them aren't. So what you disclose to them over the phone, they're always going to say, hey, we're on a recorded line, right? And they are on a recorded line, but understand that you have rights as well. And I actually tell my clients, if they're ever speaking to a collection agency, to record the phone call for their rights, and protecting their rights. But at the end of the day, let's just say it's a collection that's really been a thorn in your side. You owe it, and you want to you just want to go ahead and negotiate. Let's just say it's $500. Well, you can throw in, you can negotiate, hey, $200 today, I'll go ahead and pay it. Let's just say hypothetical situation, okay? Now, in that situation, they're either going to come back and say, okay, we'll do it, or they're going to say no, so then that's the other side of the negotiation you have to be ready for. But one of the things that I always, as far as consult with my clients, if they're going to do that, is you want what's called a pay for deletion, okay? And a pay for deletion is what you're going to want from them is letterhead saying that if I pay this debt, then I want it to be removed from my credit report, okay? And so by having that letter and that pay for deletion letter, and the collection agency would have to provide you that. And so that's part of the negotiation as well. If you're going to negotiate, have that always in the back of your mind that I want to pay for deletion. If I'm going to pay this, I want it to benefit my credit report, because why not? The worst they can do is say no. And if they say yes, not only are you paying the debt, but you're also getting it removed from your credit. And it's almost like killing two birds with one stone. And again, they have to cooperate and they have to provide that information. But as long as you know the information that you need to make sure that you hold them accountable, so they don't come back and say, "Hey, we never said that," and it's almost like it's your word versus theirs. But whenever you have like any type of an email strand or anything with their letterhead saying exactly how you requested it, then now you're in the driver's seat in the negotiation because you know the different things that you want if you pay this debt. Okay, so that the pay for deletion is a strategy that it doesn't hurt. It's only going. I mean, the worst that they can say is no, and that's your documentation to prove that they did say if I paid this, it should come off my credit.
Perfect, thank you. And I know part of the conversation today, was about credit enhancement, understanding how credit works, but also giving them business funding tips, right? So a lot of the times, a small business owner is looking to apply for a loan. And then when it comes to the credit, not the credit score, but the credit history, there's some things on there on the personal credit side. So when, determining the difference between personal credit, business credit, micro lenders, do they take a look? I know what they take a look at, but how can a business owner prepare themselves in regards to building their business credit? What does that mean? And what does it mean, to, of course, maintain their personal credit?
Great question. So, like I said earlier, your business and your personal, ideally, you want to keep it separate, but sometimes you need what we call it a boost. You know what I mean? Like when you're trying to get over the fence and you say, "Hey, I'm gonna give you a boost." Sometimes your personal credit acts as a boost to your business, to forming your business credit. What I mean by that is depending on well, first of all, organically, what you want to do is you want to there's what's called net 30 accounts. And I remember earlier I was talking about the Dun and Brad, getting your Duns number. Well, there's a couple. I call them the big three: Quill, Granger, Uline. Those are like the big three as far as they help you with net 30 accounts. So what a net 30 account is, if I think I might even got this pin from Uline, right? You'll get a bunch of pins, and so I'll call Uline and I'll say, "Hey, I want to," if I'm setting up another, a new company, and I'll say, "Hey, I want to set up a net 30 account with you guys." All right. And with that net 30 account, I want to order, 50 pins. Okay. And so what happens is, if they set the account up correctly for me, they're going to send me those 50 pins without me paying any money. Okay. So I'm trying to set up my credibility. I'm trying to set up my credit. This is a new account I just started. It's only the new company I just started. It's only been going around. I've only had it open for 60 days, and I just want to start adding, some business credit so I can build on it and continue to build on it. So I'm going to set up some net 30 accounts. And so those are the big three right there. So Quill's going to say, okay, they're going to send me my 50 or 10 pins or however many I order. And then when I get my pins, what I'm going to do is I'm going to call Uline and say, "Hey, I already have your money." Right. So I'm going to pay the money right away. Okay. Now that right there, now they're going to, now that transaction is what's called a trade experience. Okay. What that trade experience is, I'm going to get that on my DUNS number. now because I called Dunn's and I got my Dunn's number. Now and I called Uline. I had my first transaction. I did it all perfectly. So now when I look on my NAV, so nav.com is called, it's NAV, right? And so that's like Credit Karma for businesses. Okay. So with NAV, I have already set my free, and it's free, just like Credit Karma, right? So I'm going to go online and I'm going to go, my NAV account, I got that trade lines posted into my credit now, my business credit, right? So I took the first step on not having any part of my personal attached. I got my pins and I didn't have to spend a lot of money, but the fact that I did it and now it's reporting to my business credit, that's a really good start. And guess what? There's a lot of other Net 30 account possibilities out there. But that just gives you an example of how you can take one, and then after one, you can say, hey, that wasn't so bad. Let me do it again, right? And so that's the first step. It's separating your person and your business. There's some situations where you might have to be what's called a guarantor, right? So you're basically vouching for your business to the lender because you have really good credit. And let's just say you don't really have the time to, do the net 30s because you're trying to get some funding, or you have a project that you have to get going a little quicker, right? So you might have to be the guarantor. So that's that boost that we talked about, where you're helping your own company, but you just want to make sure that that debt goes on your business and not your personal, right? And it's oftentimes it's just asking the question, hey, are you guys going to report this to my personal? You might want to ask that question in email, or again, always documentation. Anytime you can document any type of question, that's always good. But the best part about that is you keep it separate and you're able to build both separately. And that's the net 30s are the organic way of doing it. And then the guarantor is more of the, I guess, aggressive, if you will. Less time, more results. And again, your credit's going to be pulled. If it's a hard pull, if it's a soft pull, it won't be pulled. But at the end of the day, they're going to, since the business may not have business credit, or they're going to take in consideration what you've done on your personal side, whether they grant you the credit on the business. So I hope that answers that question.
Absolutely. Thank you so much for the vivid examples that you're providing. It makes, helping the understanding process a little easier. And I have a question here in regards to, I don't know how familiar you are regarding DACA and the qualifying concepts, but the question reads is, it says, I hear people qualified as DACA can get home loans. Are the qualifying concepts different? Do you have any information regarding that area of, receiving?
Can you explain to me what, I don't know what DACA is, I'm sorry.
DACA? No worries. We'll have, I can ask that person to ask it live right now.
Okay.
The other question here is, it's an example scenario. So it reads, they have an agency that they paid for, and it says here that they have to keep that on their credit for 7 years, but it shows as paid off, but they won't take it off their credit. What's the process to get it removed?
Okay, so typically when it comes to positive credit, like, so say you paid off a loan like we talked about earlier, let's just say it was a installment debt that was paid off, which that's what the goal is. Typically that stays on your credit for 10 years. And so, and if it's a paid off loan, then we kind of want that to, as far as credibility wise, hey, I paid this loan off. Like that micro loan earlier, we paid the micro loan off. It's showing paid as agreed, zero balance, so that usually stays on your credit for 10 years until it just falls off in some situations. Now, if it has any kind of negative history to it, then that's when, through the Fair Credit Reporting Act, it can only stay on your credit for 7 years unless it's a bankruptcy. So 7 years is typically the time legally that negative items can hold, like, we talked about charge-offs, we talked about collections earlier. 7 years, or like, let's just say it's just negative and paid off, but it's still reporting. Since it is negative, that might that might go to 10 years just because you paid it off. It's not and it's not a charge off, it's not a collection. That's what falls in the 7-year range. So it could take 10 years for that debt to where the negative side or the positive falls off. That's usually the time frame.
Perfect. Thank you so much. And then just to end the conversation here. So DACA is acronym for Deferred Action for Childhood Arrival. So these are students, often, perhaps dreamers, the terminology. And so they're all, they're given a social security number that they can use, of course, to build, their credit, financing. And so individuals that are in that have a DACA number, or perhaps other individuals that have an I-10 number, what's the process for them? They don't have perhaps for them to build their credit or be able to have the opportunity to purchase their home, or other type of financing opportunities.
So when you say I-10, I can relate to I-10 because when I did mortgages, you can actually buy a house with the I-10 number. And so if DACA is any close relation to I-10, then you're essentially building credit the exact same way. It's a profile. It sounds like it's the same exact, where you build out that profile organically. You might have to start off with like a student credit card, or remember earlier I talked about a secured credit card where you're putting your own money down and you're borrowing against it. That's the easiest way if there's no credit to kind of start establishing credit. They're also it says that DACA, they all get SSNs. Oh, so again, it's the same exact way that you build it out, but you just want to be strategic and organic on how you build it out. And when you don't have credit, sometimes that it's really following those steps that we talked about earlier. So at least you get something, and then the more you can even build on the secured card, and you have it for like 6 months to a year, that's big right there, because now it's put you in position to add and build based off of, and everyone's going to be a little different as far as how quick or how slow they move. But the key is getting the history. So if you can have any account, like an installment, a revolving account, and you build the history, that's going to build your credit. That's going to build your credibility. And then for lenders, the more history, especially good payment history, then that's when you start getting to a time and a place where you can literally get what you want. You walk into the bank and you walk in, you have that strut when you have good credit and you got the history and you just walk in like you own the place. When you have bad credit, it's just like you have your head down and you're like stressed out, and you know what I mean? So it's just following those principles. You can stick your chest out a little bit because you know that you've put the work in, you figured out the game, you put the work in, and you know how to build credit from the ground up. And the more history and the more time that you can add to that, the better that you're going to be as far as getting any type of a loan or a house, a car. And the key is just not letting them run your credit too much, doing your homework a little bit and understanding who they pull from. And then you have your monitoring service, and you go back to your monitoring service and you see, okay, this is what I've done. And when you're able to look at it and everything's kind of in one place, like we talked about NAV, we talked about Credit Karma, we talked about Identity IQ, we talked about all the 3 credit bureaus. They have their own monitoring services. Experian, I feel as though is the best one because they give you your FICO score. And one thing that I would like to touch on that I didn't touch on earlier is when you have everyone, there's a lot of people that ask me, why does my score say on Credit Karma 600, and when the lender pulled it, it's a 650? That's a 50-point discrepancy. Why is it like that? Well, there's different scoring models. Okay, so Credit Karma is what's called a Vantage scoring model. It's kind of if you will, a cheaper model. And hence why they give it to you for free, right? But then there's FICO 6, there's FICO 8, and FICO 10 just came out at the first of the year, right? Those are all different scoring models. The principles are going to be the same as far as how you build credit, but the scores may be different, okay? And that's based off of the model. So knowing what type of scoring model that they're going off of, and you knowing what kind of scoring model, then you can understand why this discrepancy and maybe the mortgage report versus the monitoring service, which it's always good to have the monitoring service because it's not going it's not going to ding you in terms of your credit. And then it'll help you understand some of the other models a lot better because it'll at least give you a ballpark.
Perfect. And then we want to just confirm here, one of our participants wanted to confirm DACA, they all get their social security number. So we just wanted to clarify that. And then the final question here, very interesting. It's when you build your credit using your ITIN number and then later you obtain your social security number, does your credit automatically transfer to your new social security number?
That's a really good question. I don't want to answer it wrong. I'll have to come. That's a good one.
We'll have a second together.
Yeah, I'm not gonna even attempt on that one because I would hate to say the wrong thing.
And I actually want to use this time to segue here and share with you once again Thomari's contact information. So the person that asked that question, we will do our research here and make sure to connect you with Thomari. And anything else, just here's Thomari's contact. Great conversation today. Thank you so much for your time. And just a reminder, everyone will be receiving a recording of today's presentation. That way you can review and review some of this terminology, revolving credit. If you have that that older credit card that you thought about considering to close down, you might want to think twice before doing so. As that it's a good tracker of your good credit history. So thank you so much. And I want to continue by inviting everyone that's still connected here or through Facebook Live. We will be continuing our webinars. And next Wednesday at 8 a.m., we are proud to welcome back our monthly breakfast virtual meeting this time, of course. And we are honored to have Mayor Jerry Dyer as our first keynote speaker of 2021. So please join us. Here is the information on how to RSVP and also the meeting ID to join us. And we will keep you posted on other webinars. And here is the contact information for the foundation. Thank you once again, everyone, for joining us. I hope you have take care of yourself, stay healthy, and please let us know of other topics that you would like to hear in the near future. Thank you, everyone, and have a good day.
Thank you.